Chapter 13 talks about relevant cost. The first question here is a concept in the decision-making process. It says, which of the following is not a step in the decision-making model? And the answer is E, none of the above, because in fact, all of these items are part of the decision-making model. In the decision-making model, the first step is to recognize and define the problem. Second is to identify any alternatives as possible solutions. Step 3 is to identify the costs and the benefits associated with each alternative. Step 4 is to estimate the relevant costs and benefits for each alternative. Step 5 is to assess any qualitative factors. And then step 6 is to make the decision. So A, B, C, and D are all part of that process. Question number 2 is just asking you if you understand what a make or buy decision is. Obviously, a make or buy, you can either produce the component in-house or you can purchase it externally. So it's an outsourcing question or an outsourcing decision. So your answer on 2 is C. Number 3 says, which of the following statements is true about decision making? Relevant costs are for the best alternative not taken. Relevant costs are the same among competing alternatives. Well, that's incorrect. We know that to be relevant, it has to differ. So B is clearly incorrect. C, relevant costs differ among the alternative. Obviously, that's correct because that's what we just said. So your answer on 3 is C. Number 4 says, which of the following is a percentage applied to the base cost that includes desired profit and any cost not included in the base cost? And this is a markup. Okay, so if you're going to mark up the cost, that helps you to set your selling price. Number 5. The company plans to eliminate a branch that has a contribution margin of $50,000 and fixed cost of $75,000. Of the fixed cost, $55,000 cannot be eliminated. The effect of eliminating the branch on net income would be, so we want to see what would happen if we eliminated the branch. If we eliminate if eliminated, what's going to happen is that you are going to lose the contribution margin, okay? So we are going to lose $50,000 of margin because it's the revenue would go away plus the variable cost would go away. So if we eliminate, we're going to lose $50,000. And then we want to compare that to with how much expense would go away or be lost if we eliminated. And it tells you that fixed cost is $75,000. Of that fixed cost, $55,000 cannot be eliminated, meaning regardless of what we do, whether we keep the branch or eliminate the branch, we're still going to have that $55,000 of fixed cost. So what can be eliminated is the $20,000. So if we eliminate, basically what we would end up doing is we would lose $30,000 in income. So income, this is what would be eliminated. So $30,000 of income would be eliminated. So overall, it would decrease your overall net income by $30,000. 6 is asking whether we should sell as is or if we should process it further. It says we have 3,000 out-of-style winter hats that cost the company $6,000 to manufacture. If the hats are restyled for $2,500, they can be sold for $5,000. The other alternative is to sell them for scrap for $1,000. So which alternative maximizes the pre-tax income? So basically, we've reached this what we call split off point. Okay, so up to this point, we've incurred $6,000 of cost, which we don't care about because regardless of whether we restyle them or whether we sell them for scrap, we've already paid the $6,000. So it's a sunk cost. We don't care about it. We want to ignore it. So now our options are either to restyle. So if we decide to restyle the hats, we can sell the hats for $5,000 of revenue, but we're going to incur $2,500 of expense. So it's going to leave us with $2,500 of profit. If we sell for scrap, then we're going to have $1,000 of profit. So obviously you're just trying to determine which one is going to give you the highest profit. Restyling is going to be the best. So your answer on 6 is A. The next question is a make or buy. So we have a situation where we have a part that's part of our colored printers. We can produce the part ourselves If we produce the part ourselves, we have material, labor, variable overhead, and fixed overhead cost. We use 100,000 units of that part per year. So we can either make it ourselves or we can purchase it for $10. And it tells you that the fixed overhead is unavoidable. If it tells you that it's unavoidable, it means that total fixed cost is going to stay the same regardless. So whether we make the part or whether we buy the part, total fixed overhead is still the same. So it's irrelevant. We're going to leave it out. We don't care about it. So if we look at the relevant costs to make, the relevant costs to make are going to be direct materials plus direct labor plus variable overhead. So your relevant cost to make is $11 a unit. You have $100,000. So your relevant cost to produce the component is $1,100,000. The relevant cost to buy it is you're going to pay $10 a unit. You're going to have to purchase 100,000 units. So your relevant cost to buy is $1 million. So obviously you want to do whatever is going to be the least expensive. So you want to buy the part because it's going to save you $100,000. So your answer here is B. Number 8, again, is a make or buy question. It says we can make 100 units of the necessary component. We could purchase it externally. 2,000 of the fixed cost can be avoided. That means that $20,000 out of the 35 is relevant. So it says at what external price for the 100 units is the company indifferent between making or buying. Remember, we're going to be indifferent. That means we're not going to care, and you're not going to care when they're at the same price. So basically what the question is asking you to do is find the relevant cost to make. Okay, so we're looking at the relevant cost to make. So the relevant costs to make are going to be direct materials, direct labor, plus variable overhead, plus any avoidable fixed cost. And it tells you that the avoidable fixed cost is $20,000. So your cost here is $153,000. So if you want a formula for your relevant cost to make, so if you want to just write something down for your relevant cost to make, it's going to be direct materials plus direct labor plus variable overhead plus any avoidable fixed overhead. And the information in the problem should somehow tell you about the avoidable fixed overhead. Obviously, your relevant cost to buy is just whatever it costs you to purchase. It's fairly simple. Question number 9 says that we have just designed a new product with a target cost of $64. We require a new product to have a profit margin of 20%. What is the target price for the new product? So we don't know what the sales price is. That's what we're looking for. We know that the cost is $64. And we want our profit margin to be 20%. Thinking back to the prior chapter, if you think about what margin is operating income divided by sales. So the margin is 20% of the sales price. Okay, so thinking back to the prior chapter, margin is income over sales. So margin times the sales price gives you operating income, and it tells you that we want to have a margin of 20%. So now we just want to fill in everything that we know. I'm going to isolate the SP, what we're looking for. So to do that, I'm going to bring the 20% SP to this side of the equals, and I'm going to swing the $64 to the other side of the equals. So that leaves me with 80% SP equals $64. Do 64 divided by 80%. So your selling price is equal to $80. So your answer on 9 is D. Question number 10 is a special order. It tells you that we make toy airplanes. One plane is an excellent replica, sells for $5. A particular airline wants to purchase 12,000 planes at $1.75 each. So clearly it's less than the normal selling price. wants to give the airplane to children that are flying alone. Costs per plane are as follows. No variable marketing costs would be incurred. The company is operating sufficiently below the capacity, so we have plenty of excess capacity to take on this special order. No fixed costs are avoidable. So total fixed cost is going to stay the same whether we take on the special order or not. However, the Vacation Airlines wants its own logo and colors on the plane. The cost of the decal is 1 cent per plane, and the special machine costs $1,500 would be required to affix the decals. We want to see whether we should accept or reject that special order. So remember, for a special order, what you're looking for is you want to say, if accepted, what would be the additional revenues minus the additional expenses. Okay, so what we're looking at is, if we accepted, what would be the additional revenues minus the additional expenses. So for your additional revenue, we are going to sell each plane for $1.75 a piece, and we would sell 12,000 planes. So that's going to be your additional revenue. As far as the additional expenses go, we can look at our variable costs that we're going to have. Obviously, direct materials is relevant, direct labor is relevant, variable overhead is relevant. However, fixed overhead is not. So you have $1 plus 50 cents plus 10 cents plus this penny over here, because in addition to the normal material, labor, and variable overhead cost, we also have the cost of the decal, which is going to cost us an extra penny. So your additional variable cost is going to end up being $1.61. So $1 plus 50 cents plus 10 cents plus 1 cent gives you $1.61 times 12,000. And then we also need to take into account as an additional expense the cost of the machine, because it tells you we're going to have to pay $1,500 for this additional machine. So when you work all that out, that's going to leave you with $180. So if this is the case, if your number comes out to be positive, this would be additional revenue, or I'm sorry, this would be additional profit that you would incur if accepted. So your answer would be yes, you would want to accept the special order because your income is going to increase by $180.